Aside from the busiest week of earnings season, the other big story markets are watching here, the Fed. Our Bob Pisani is down at the NYSE with what's on investors' minds. Bob.
Hello, Melissa. The markets moved sideways today despite lousy guidance from 3M, Lockheed Martin, and others. And the Fed may have had something to do with this. First, there's the Fed drift. This is the well-documented tendency for U.S. equities to rally in the 24 hours before a Fed meeting concludes. Next, here, we've got the markets have come to believe that the Fed and other central banks are getting on their side, and that's the dovish side. In the past couple of months, central banks around the world have signaled that they will not be raising rates aggressively. And there have been hints that they would be very stimulative if they need to be. China has essentially already taken this path. Now, this change is critical to market sentiment. Traders believe that the two most important issues that determine the direction of stock prices are first, earnings, and second, liquidity. Liquidity is just how much money there is to invest. And the primary determinant of liquidity is central bank actions. Now, traders are clearly expecting a more dovish Fed. Fed Chair Jay Powell said in December the Fed will be, quote, patient before raising rates. Well, that's different from the prior narrative that the Fed would be gradually raising rates. So will that sentiment be reflected in the new statement? Our CNBC Fed survey indicates 100% expect the Fed not to hike in January. And while 78% expect at least one rate hike in 2019, 17% expect a cut. As for 2020, those numbers dropped to 48% expecting a rate hike and 37% expecting a cut. Finally, there's this issue of the Fed's balance sheet. Powell has shifted away from the idea that they are on autopilot in reducing the balance sheet each month. And the question now is, what is the overall impact on interest rates when the Fed has stopped buying treasuries and the deficit is rising at the same time? That'll be a critical question. Back to you, Melissa.
All right, Bob, thank you. Bob Pisani at the NYSE. So will the Fed deliver tomorrow or with a press conference after the decision is released? Does that introduce volatility?
Well, that's going to be the key. I mean, Powell has successfully walked back the kind of hawkish tone that he took that really rocked the markets. And I think he should probably take a do no harm approach to this. Don't say anything that's going to change what's going on in the market. Clearly, they're impacted by what's going on with the stock market. So I would just say, the wild cards here are if they say anything about autopilot, going back to that autopilot, that would be negative. If they say anything about the balance sheet, maybe expanding or an Operation Twist type of thing, I think that'd be very positive for the market.
Operation Twist?
Yeah, well, a reverse Operation Twist. It would be a rock.
Yeah. We had all kinds of creative stuff out of the Fed a few years back, and I agree with Brian. I think the risk is to the downside for markets in terms of expectations here. We were at 8% expectation of a June hike around just after Christmas time. We're now closer to 20 again. Last week, I think most of the equity markets rally was all about this removal of essentially the $50 billion a month. So I think if anything, there's risk to the downside on that. We have a payroll number on Friday. The mitigating part, consumer confidence today was awful. We were at a level that we hadn't seen since July of 17. Expectations were back to 2016.
Yeah, I liked, and nobody but me likes this, but I like the October Jerome Powell much more than I like 2019.
Well, the markets didn't like the October Jerome Powell.
Yeah, I understand. I get it. But I would like, listen, we seem to be on more stable footing, it appears to be. I mean, especially given the results of Apple's earnings today. I would like for him to say, you know what? Market seems to have corrected itself. He won't say these things, by the way, and we're still sort of on board with reducing our balance sheet, not necessarily autopilot, and we're still looking at 2 hikes this year. That would be
There's
lovely.
a zero chance that he could be any dovish enough for the market is already pricing in the ultimate dove, right? There's 100%. Zero chance of him raising rates tomorrow. So anything he says now is going to fall short. So I agree. I think it's downside risk to the market. But the problem is the market's run so aggressively that he might open up his mouth. And that's going to be the biggest problem for the overall market.
You think that bounce back from December, so a bounce back that took place in 1 month is enough for the Fed, for Jay Powell to actually take back some of the dovishness and introduce some hawkishness?
Yeah, I absolutely think so. I mean, clearly, a couple days after he made those statements, the market fell, and all of a sudden they trotted out every Fed president to say, oh, we didn't really mean that. And I would just say, I think in general, if there's one tell out there, look at what gold's telling you. gold is on fire. It's telling you that central banks around the world are going to start turning on that spigot again. That's the view I'm getting.
Look, financial conditions are significantly looser than they were 6 weeks ago, and certainly a lot looser than they were about 10 weeks ago when you had rates at 3.25. So the Fed is paying attention to these dynamics. Look, if the Fed was able to be affected by market conditions to actually, push things up, because again, the data has not in this country gotten significantly worse. Let's be clear. So we saw financial conditions seize up somewhat in December. If the Fed reacted to that on the downside, I think they're reacting to that on the upside.